Good morning, everybody. Welcome to today's episode of Wise Tech for Wise Money, the podcast where we speak with industry leaders, founders, and investors about how experience, strategy, and technology come together to build stronger, more intelligent businesses. I'm Gary Wayne, founder of A1 Solutions. We work with founders, leadership teams, and financial businesses to improve efficiency, scale intelligently, and grow through smarter use of systems, operational strategy, and AI-driven automation. Today's episode is titled The Reality of Capital Fundraising, Tax, and Why Experience Still Wins. There is a lot of noise in the market today. Everyone talks about access to capital, AI, opportunity, but the reality underneath is very different. Today we will explore what is really happening in fundraising markets, how tax frameworks like EIS influence capital, and why experience still matters. I'm joined today by Martin Sherwood. Martin is the founder of Enterprise Investment Scheme Association, has extensive experience in UK venture capital, and continues to work actively with entrepreneurs, investors, and capital structures. Martin, welcome to the show. Maybe you could give us a little bit of background about your journey, your career, and how you got to be where you are today.
I often get asked that question by young people who are desperate to construct careers, and they run up to me and they say, "How did you get to where you got to?" And I find that very flattering and quite touching. And I always say to them, it's a lot of it is chance. So you've got to be in the right place at the right time. That means, making sure you get out and about, meeting people. It's just essential to keep out and about and building up a network as broad as possible. So I got into tax-efficient investing a very long time ago, and that was a kind of a chance meeting. I was sharing an office with young people who seemed to have a much more interesting business than I did. And long story short, we combined our businesses, and I sort of took on the mantle of their business, which was financial product. And back in those days, people didn't really know what financial products were. So it was very early days, but I was in at the beginning of the Enterprise Investment Scheme, which started in 1994. It succeeded something called the Business Expansion Scheme, which had run for 10 years under the Thatcher government and expired because it had a 10-year lifespan. It was succeeded by the Enterprise Investment Scheme, but they dropped the income tax relief from 40% to 20%. So a lot of people left the industry saying, I can't work with 20%, that doesn't work. And so suddenly I found myself in a relatively new industry, and everybody was leaving it. I decided to stick with it for a while to see how it panned out. So I did, and all through the 1990s, the EIS was really quite small. It was a small market. I was one of the bigger players in a small market, but it built, and it has become, over the years, an absolutely outstanding scheme. I'm talking about the EIS. It had various peaks in its life cycle. So the first peak was the build-up to the dot-com boom, and many people today are too young to remember what that was. Gary, I'm sure you can remember, but it was a fairly exciting time, and a lot of people began to focus on the Enterprise Investment Scheme. They began to focus on investing in startup and small businesses. High earners were attracted by the income tax relief they could obtain, and the freedom from any tax on profits they made. So it became, suddenly became an attractive place to be. And a number of the leading players in the EIS market today, they entered the industry around about that time. It's around about 25 years ago. We then had what was known as the dot-com bust, which followed the dot-com boom.
I remember it all very well.
It's fine, actually, because the stock market lost an enormous amount of value. The years 2001, 2, 3, terrible years, really bad. But it built back, and we then began to grow the scheme again. And the next peak was round about 2007. And that was really the best year in that decade. And that built up to a peak, and we expected it to go onwards and upwards. But we then had something called the banking crisis, 2008. I'm sure many of you can recall. And so we had another dip. We got over that. We got through that in the end, and then we built again up to another peak just pre-pandemic. And then, of course, once we were into COVID, everything collapsed in 2020. People sat at home. Nobody dared do anything. There was a dreadful drop in investment levels. But once COVID began to be over, people came back into the market. And there was a lot of pent-up cash. 21, 22 actually were two quite good years. And since then, it's gone slightly sideways. And that's due, I think, mainly to a number of factors, but mainly to the fact that the traditional EIS investors have been starved of exits. And they've not got out of their EIS portfolios fast enough, and not, in the 3 to 5 years which were advertised when they invested in the schemes. They're still in them. They're still trying to get out. Some have exited. But a lot of EIS investors are now saying, until I get money back from my EIS portfolio, I haven't got any more money to put back into that particular market. So that has led to a slight downturn in recent years. So we're very hopeful now that with all the technical advances that are going on, that we can build back the growth in the marketplace.
Why are people struggling to get out of their EIS portfolios?
Well, the EIS investors, they like liquidity, so they like the tax reliefs, but they want to be able to get out relatively promptly. Some do. I mean, don't misunderstand me. A portion do. There have been some reasonable exits in the last 12 months. A lot of them from high-speed tech investments, but a lot of non-tech investments have proved very difficult. They've lost a lot of money. Some have failed completely. Some have gone sideways and have got about half their value left. Managers, owners hanging on, not wanting to exit, trying to improve value before they exit. So there's been a lot of blockage in the EIS pipeline.
How does today compare to when you started, business-wise? Is it harder today to succeed despite more access and more technology?
Well, I would say that it's become hugely more competitive. I mean, it's just immensely competitive now. But one of the side effects of that is that the standards have gone up. The standards of a typical EIS qualifying investments today are way higher than they were 15 and 20 years ago. We did have periods of very safe, low-risk investments. That was when the government deliberately used the EIS scheme to accelerate investment into certain sectors. The best example of that is renewable energy. So we're going back about 25 years. The government realized that not enough money was going into renewable energy fast enough, the government had a legal commitment to achieve certain levels of renewable energy within certain timescales. And in order to bring that about, they decided to make investments in renewable energy in the UK tax efficient. So it was a double whammy, really. They were already subsidizing renewable energy, and they were also subsidizing it through investment into renewable energy. I'm talking about solar, wind. Those were the two primary renewable energy technologies. There were others like anaerobic digestion, but by far the most popular and successful was solar energy. And it was, to my mind, quite simple. The reason for that was that people understood it. They started putting solar panels on their own roofs. They absolutely understood it. It was terribly simple to sell and to explain to the advisory market and to investors.
What separates those who succeed and those who don't, in your experience?
That's a very big question. So, I mean, EIS has been through various iterations, and the rules have changed over the years. It's been seriously challenged about twice during its 30 years. Once was when Labour came to power in the late 90s. They didn't like the look of enterprise investment scheme. They thought it was something that had been cooked up by a Tory regime. And they took some persuading that they needed to keep it. And I was quite involved in meetings with Treasury and so on at that time. In the end, it survived, but it was amended, and the amendments, there was a list of 5 different asset classes, so care homes, hotels, property development, etc. They were all disqualified because they were seen to have little or no risk, or much less risk than more genuine trading businesses. Then much later on in 2018, the government, I mean, all the way through this process, the government was always seeking evidence that the scheme worked and that the tax relief that was being given to investors was actually paying for itself. And so we kept having to come up with evidence of investment into a typical company that achieved, say, £1 million of fundraising, and that meant that 30% of that was given away to investors in tax relief. And they wanted to know if they were getting that, that 30% back. And we were at pains to demonstrate that they were, through building up successful businesses, which ended up paying tax through VAT, and all the corporation tax and employment taxes. So there was a lot of history. Then we came to 2018, and they launched something called the Patient Capital Review. It was a slightly unusual name, but basically what they were looking to do was to get evidence and proof that the schemes were still working. And they introduced a number of amendments to the rules, which basically reduced the slightly artificial structures and made them, they disqualified them. So it put more focus on building up a genuine trade that had risk involved. So basically, since 2018, investors have not been able to obtain tax relief unless there has been a reasonable element of commercial risk in the investments they've made.
Can I just ask a question? What was the actual original thinking behind funding the EIS Association?
Well, it was very early days, and so I and a couple of colleagues back then, we said, let's form a trade association and try and make this scheme better known, because we were going out and about trying to sell investment in the enterprise investment scheme, and you spent 2/3 of the time explaining to people what the scheme was. So it was, it was very a little known, and we felt that it deserved some sort of a presence. So we thought up a scheme to invent form a trade association, and we did. And we held a. This is going back a long time. We held. I went out and got sponsorship from a law firm who I was quite friendly with at the time, who were specialists in tax-efficient investing, and they were kind enough to give us a small amount of seed funding. We organised a lunch, which was a lunch in a West End hotel, and we invited people in the industry to take tables, and they did. And people came to that event, and it was a huge success. And we turned around at the end of that and said, we're doing something right. We're onto something here. So that was the start of it. But there have been many, many developments over the years in building up the organization, and it's been a question of recruiting the right people, which I've been really closely involved with.
What do people misunderstand about it nowadays? Is it a tax-driven, incentivized operation, or a business-driven?
Well, it's both. I think people now fully appreciate the tax benefits to the investors. We've had, the government experimented with various levels of income tax relief, but settled on 30%. Venture capital trusts, which I was also involved with, they're also up and running later than EIS. But they came in, and at one point they were providing 40% income tax relief, while the EIS was only offering 20%. So that was, we had to lobby long and hard to get the 20% raised. And finally, the government did, and they lowered the VCT rate to 30% and raised the EIS rate to 30%. So they've been on parity now. But just recently, there's been a dislocation, if you like, and in the last budget, the Chancellor announced that investment from this April onwards into VCTs would only attract 20% and not 30%. So a little bit hard to understand why they did that, and that was completely surprising. I think they've taken the view that investments in VCTs are less risky than investments in EIS because VCTs tend to invest in later stage businesses. I think it's as simple as that. So what I haven't mentioned yet is the introduction in 2012 of the seed enterprise investment scheme, which was introduced by the Tory government. Back then it was Osborne, the Chancellor, and that was introduced as a temporary measure to help the startup entrepreneur economy. And it was immediately very successful. It offered 50% tax relief for the first £150,000 of investment in a startup business. Well, 50% tax relief sounded very successful. So that got off to a roaring start. And it was so successful that, like many things that were introduced as temporary measures, it became permanent almost immediately. It's been there for 14 years now. We've had the SEIS, and so what startup and growth businesses now have got this. They've got the SEIS to start with, and that's now been raised up to 250,000 thanks to our lobbying, and so the first 250,000 can be SEIS qualifying. Once you've used that up, you can then move on to EIS. And the thresholds on EIS have increased also recently. So the EIS market has been broadened, it has been strengthened, it has been supported, it's been extended now to 2035, which again we lobbied long and hard to get. And I'm pleased to say that the current government, when they came into power in 24, they immediately saw the benefit of extending the scheme for another 10 years. So that was a massive step forward.
How hard is it to raise capital today? What's changed the most in recent years? And what tells you what's worth investing? You know, what the companies or businesses the EIS should apply to, you know, structure-wise.
Well, I think there's lots of questions in that, Gary. So let me try and answer that quickly. I mean, COVID made an enormous difference. So from the day lockdown started, it was impossible to raise any money really at all for anything that was non-tech. So people were all sitting at home in front of their screens. The only investment focus was on tech. And within tech, the sweet spot was seen to be subscription-based businesses, B2B SaaS, subscription as a service businesses, and to this day, that remains a sweet spot. It's incredibly popular. There have been tech companies that have started in the COVID period, in the lockdown period, and have exited already. So, within 3 to 4 years, they've achieved an exit. Those exits have been often to private equity funds, who are also attracted to the reliability of subscription-based businesses. So, there's been a tremendous shift towards tech. And then, of course, we then got all the subsets of tech. We got ed tech, fintech, med tech, insure tech, and all the other techs. And so, that is just demonstrating how popular tech has become. It has recently become a little less difficult to raise money for non-tech businesses, but it's still a great struggle. And people approach me all the time wanting to know how to go about raising funds, and I always say, good luck. If you're non-tech, you need to demonstrate quite a lot of experience, quite a lot of commitment to the sector you're in. You need to know lots of people who know you and trust you. It's harder. It's harder. So it's sectors I could mention. I've mentioned renewables. I've mentioned tech and all the subsets of tech. There was one industry, in fact, that we were active in that did well out of lockdown, just a single one that I can mention other than tech, and that was the storage industry. Because what happened when lockdown happened was everybody started working from home and they had to declutter their homes because they didn't have enough space to create an office. So that meant an enormous burst of increased income for the storage industry. We had a number of EIS investments in storage, and we exited all those in the last 2 or 3 years, and the asset values of the storage units were greatly enhanced by what had happened during lockdown. So that was just one of those strange oddball benefits.
What do you see that makes entrepreneurs successful in your experience? And what sort of patterns do you see today where people do right and do wrong?
I mean, I have to say, I have, I think a lot of funders do a preference for experienced entrepreneurs, people who've done it before, and they're known as exited entrepreneurs. So, I mean, I'm working at the moment with somebody who's a twice exited entrepreneur. So these are people who've got creating businesses in their blood. They simply love doing it, and they've done it once and made quite a lot of money, and then they've decided to do it again, and they've made money again. It's a bit like a drug. It becomes absolutely intoxicating. Those are wonderful people to work for. Now, having said that, just because you've had a successful business doesn't mean your next venture is going to be successful. So I find there are very few hard and fast rules. and sometimes young entrepreneurs are extremely successful first time off, and first time round, and they then go on to try and do it again, and some succeed and some don't. So, and then you get entrepreneurs who've been unsuccessful 2 or 3 times, and keep on trying, and suddenly they get a success later in life, in their 30s, 40s, or 50s. And that's, really interesting as well. And so there are really no hard and fast rules. There's no set pattern here, but people who have done it before and have experienced the pain or experienced the adrenaline rush of building up a startup, that often I think is extremely important.
Is there any common, you know, intelligence or skill set that makes these entrepreneurs successful that you
Uh,
see?
Not really. Um, uh, Usually they're very good at attracting people to work with them, because people love a winner. People love somebody who's got a great business idea that they believe in. So they often attract, a team of people to work with them. Um, so, I mean, a founder very often has a partner who's the technical partner. So, as a CTO, so a CEO with a CTO is a combination you encounter quite a lot, and that usually is a combination of two people. The CEO is the front person, and the CTO is the back room person. The CTO is quite happy sitting in front of the screen all day long, developing the software, etc. And the CEO is out there raising money and running the business. So that's a combination we see quite a lot.
How do you see the state of the current capital markets? Is capital still available?
Yes, it is, and there's a lot of cash, huge amount of cash. Um, there's a fair amount of hesitation, I would say, by investors. Um, Fairly obvious reasons, geopolitical reasons. People are nervous. Is this the right time to put my cash into something? Shouldn't I just be staying in cash for the time being until I know what the future is going to hold? I mean, I think the future is going to hold more of the same. I think the uncertainty is now increasingly going to be a way of life. People are simply going to have to come to terms with that. So um, hopefully there will be a balance between making safe investments for certainty, and riskier investments for potentially greater returns.
How has technology improved outcomes, or has it just increased the noise? For
Well, I
example,
mean,
AI, etc.
yeah,
How
you're
is that
obviously talking
affecting?
about AI, and so none of us, you probably did, Gary, but I didn't know what AI was, 2 or 3 years back. But I think we've all now discovered what it is. Um, Apparently, AI has been going for years. So I'm involved with a fund where um, the AI guru in the fund, he's been a professor of AI at a British university for 20 years. So AI has been around a long time, but it hasn't come to the fore until very recently. Um, I'm not a technical expert, so I know what good AI does, and I know what bad AI can do. But if I spot a company, I can't tell immediately whether it has the right kind of AI, agentic AI, whether the AI has just been bolted on, how secure the technology is. This is all down to, I rely on other people for technical support and confirmation. So, um, I mean, AI has become extremely interesting and challenging. It seems to me it works better in some professions than in others. I mean, it works where there's a huge amount of documentation involved. So the legal profession, I can see where AI comes into play there. And contractual affairs, legal contracts. That's one area, I think. But another area which is particularly interesting, which I've become quite closely involved with, is data security, because with AI, you've got data, and if companies merge, if people want to do things, they have to move their data, and moving the data is risky, and so data security is an extremely important market at the moment.
We saw, as you mentioned earlier, the dot-com boom. We're seeing now an AI boom. Do we think we're going to see the same result with a AI bust within the markets?
It's a question people are asking themselves, and it's a question I ask people, and the answers I'm getting, on the whole, are that the bad AI or the insecure AI is not going to survive, but the good AI built on solid rock foundations will survive. So there's clearly there is risk in that. So and then people come along to presentation events, and they say, is there AI in your business? And the founder says, yes, there is, and they nod as if that's all they have to do. Quite obviously it's much more complicated than that, and so you need a lot of technical knowledge and support in order to be able to find your way around.
Yeah, it also obviously it depends on the business complexes, etc. How do you see the next 3 to 5 years? More opportunity or consolidation? I mean, we talked about geopolitical situations, but really since the millennium, we haven't seen anything but more disruption, more global problems.
Yeah.
I wonder how you see the EIS scheme moving on, how you see businesses expanding or not expanding. We've seen Trump come to the forefront, where free trade seems to be, in danger in some respects. What's your overall view?
As I said just now, I think uncertainty is here to stay, and I think people have got to be able to get to grips with it and live with it. So, I mean, I think the immediate outlook is people, people in general have got to be more self-reliant. There's going to be huge emphasis on defense and security, and that means everybody, members of the population, are going to have to know what to do when the power goes out. Have I got batteries in the house? Have I got a torch? Where do I go to turn the power generator on? So I think there's got to be much higher levels of self-reliance. And so defense obviously is going to be an incredibly important sector. Security, hugely important, including, data security, as I was mentioning before. I think power sources are going to be really important. So I think it's going to be around, basics like self-reliance, defense, security, power. Those, I think, are going to be the main areas of focus.
Okay, well, it's been a very good podcast. What I'd love to ask you, as an elder statesman, and I don't mean that in any bad shape, what is your key advice to the youngsters out there now, the young entrepreneurs looking to make their way?
Well, it's become hugely more competitive in recent years. It is very, very competitive. And also another thing that I haven't mentioned, which I think is going on, is that if you have a good business idea and you want to raise money to develop the idea, it's much harder to do that now. Investors are looking for businesses that have already proven the concept. So a minimal viable proposition, MVP, people are looking for that. Quite a few funds will only invest if the business is up and running. It's got a minimum 1 million annual turnover. So I think investors are coming in at a later stage. So startup entrepreneurs, founders are going to have to find ways of financing the startup of their business through grants, through being in touch with the right key funding partners. So I think it's later stage. And, another thing people have got to be able to do is to pivot. So if they've got a business idea, they start the business, but then they realize they haven't got the business quite right. They need to adjust the business, change the business. You've got to be prepared to pivot the whole time. You've got to listen to your customers, because without customers, you don't have a business. You only have a business when you've got customers who pay and who are prepared to continue paying for your service. So, that sounds pretty obvious, but a lot of people get blinded by their brilliant new idea and can't believe that other people don't get it,
Yeah, I can understand that. Okay, Martin, well, thank you very much for this insightful conversation. Could you please tell the audience where they can find you? If they want to learn more about the EIS scheme, if they want to talk to Martin in person, where can they contact you?
Well, I'm on LinkedIn, so Martin Sherwood on LinkedIn. I would like people to visit the Enterprise Investment Scheme Association, ESA for short, website, because it's a brand new website we've just upgraded, and it's terrifically good. It's full of information about the EIS, how to use it, etc. And that is www.org.uk.
Fantastic. Okay, well, everybody, I want to thank everyone for listening in. Martin, I want to thank you again for being a guest. Everyone can find me on LinkedIn as usual, or they can find me via my website, www.a1solutionsintl.com. Thanks again, everybody, and thank you, Martin.
Thank you. Bye-bye.